Hello everyone and welcome. Today we are diving deep into a question that crosses the mind of almost every homeowner who also has an interest in investing. The question is this: does it make sense to take out a mortgage or keep your existing mortgage and invest that borrowed money into a broadly diversified ETF like the FTSE All-World? Some people call this mortgage arbitrage. Others call it leveraged investing. The concept is simple in theory. If the bank lends you money at a low interest rate and your investments yield a higher rate of return, you get to pocket the difference. But is it really that simple? Is this a genius wealth-building hack? Or is it a direct path to financial ruin? To answer this, we need to move past opinions and look at cold, hard data. We are going to examine current mortgage rates, specifically focusing on the TAEG. We will look at the historical performance of global markets, specifically the FTSE All-World Index. We will run the math on taxes, inflation, and volatility. By the end of this video, you will have a clear mathematical understanding of whether this strategy makes sense for you. Let us start with the cost side of the equation. If you are borrowing money, you have a hurdle rate. This is the absolute minimum return your investments must generate just to break even. When looking at mortgages, especially in Italy and across Europe, you will constantly see the term T. This stands for Tasso Annuo Effettivo Globale. If you are watching from the US or UK, this is equivalent to the annual percentage rate, or APR. You must use the TAEG for this calculation, not the nominal interest rate. The nominal rate is just what the bank charges on the principal. The TAEG includes everything: the origination fees, the notary costs, the mandatory bank insurance, and the appraisal fees. So, where do we stand today in 2026? Recent data shows that the European Central Bank has held its key interest rate steady, keeping the deposit rate at 2%. Because of this stable environment, average fixed-rate mortgages in Italy are currently hovering between 3.05% and 3.43%, depending on the length of the loan. Forecasters and analysts expect fixed rates to remain in this 3.0% to 3.40% window for the near future. But remember, that is the nominal rate. Once you add in the upfront costs, the mandatory fire insurance and the bank fees, your actual TAEG might be closer to 3.6 or 3.8%. For our mathematical example today, let us assume your TAEG is exactly 3.8%. That is your cost of capital. That is the dragon you have to slay before you make a single cent of profit. Now, let us look at the investment side. If you are investing borrowed money, you absolutely cannot afford to gamble on single stocks, crypto, or narrow sector ETFs. You need the broadest, most diversified investment vehicle available. This is why most investors looking at this strategy choose a global equity index, like the FTSE All-World. The FTSE All-World Index tracks over 3,000 large and mid-cap companies across roughly 50 countries. It includes both developed markets like the United States, Japan, and the UK, as well as emerging markets like India and China. It is, essentially, a bet on human progress and global economic growth. What do the historical numbers look like? If we look at the data over the last 22 years, from roughly 2003 through early 2026, the FTSE All-World Index, denominated in euros, has delivered a compound annual growth rate of 9.64%. Let me repeat that. 9.64% per year, annualized over more than 2 decades. If we just look at the raw spreadsheet math, the decision seems incredibly obvious. Your cost of capital is your TAEG of 3.8%. Your historical average return is 9.64%. That leaves you with a positive spread of roughly 5.8%. If you take a mortgage of 200,000 euros and invest it, a 5.8% spread means you are essentially generating over 11,000 euros a year in wealth, compounding over time just by utilizing the bank's money. It sounds like financial magic, but spreadsheets do not reflect the real world, and this is where we have to start stripping away the illusion of free money. First, let us talk about taxes. The bank's 3.8% TAEG is guaranteed, but your 9.64% stock market return is a gross figure. Depending on where you live, you have to pay capital gains tax. In Italy, for example, the standard capital gains tax on financial instruments like ETFs is 26%. You also have wealth taxes, like the Imposta di Bollo, which takes 0.2% of your portfolio value every single year. When you factor in that 26% tax on your gains and the annual drag of the wealth tax, your net compound return drops significantly. Your 9.6% gross return might look more like a 7% net return when it is finally time to sell. Suddenly, your profit spread is no longer 5.8%. Your net return of 7% minus your 3.8% TAEG leaves you with a net spread of just 3.2%. Then, there is inflation. Now, inflation technically helps your mortgage debt, because you are paying the bank back with money that is worth less over time. However, it also erodes the purchasing power of your investment gains. While your nominal wealth might go up, the real spending power of that spread is tighter than the raw numbers suggest. But taxes and inflation are just math. The real reason this strategy destroys some investors is psychology and volatility. The 9.64% historical return of the FTSE All-World is an average, but the stock market never gives you the average in any given year. The standard deviation of the FTSE All-World over that 22-year period is nearly 13%. This means the returns swing wildly from year to year. Let us look at the historical drawdowns. In 2022, the index fell by 13%. In 2018, it fell by 5.3%. And during the 2008 global financial crisis, the index suffered a catastrophic loss of 38.7% in a single year. Imagine this scenario. You take out a €200,000 mortgage against your home today. You invest it all into the FTSE All-World. Next week, a global recession hits, and the market crashes by 40%. Your investment is now worth €120,000. But here is the terrifying part. The bank does not care that the market crashed. The bank still wants their fixed monthly payment, calculated on the full €200,000 you borrowed. Historically, the deepest drawdown period for the FTSE All-World required immense patience. If you invested at the peak in October 2007, it took 5 years and 3 months, until January 2013, just for the index to recover its previous highs. Could you sleep at night for 5 solid years, knowing your portfolio is heavily in the red, while writing a massive check to the bank every single month? This is called sequence of returns risk. If the market crashes early in your borrowing period, the math breaks down. You are paying interest on capital that has evaporated. Furthermore, market crashes often coincide with economic recessions, which is precisely when you are most likely to lose your job. If you lose your income and can no longer afford the mortgage payments, you might be forced to sell your stocks at the absolute bottom of the market just to avoid foreclosure. This is how leverage turns a temporary market decline into a permanent life-altering financial loss. So, does this mean you should never do it? Not necessarily. For a specific type of investor, this strategy can accelerate wealth building, but you must put strict guardrails in place. First, you must use a fixed-rate mortgage. Taking a variable-rate mortgage to invest in the stock market is financial suicide. If inflation spikes, the central banks will raise interest rates. Your mortgage payments will skyrocket at the exact same time the stock market is likely crashing due to those higher rates. A fixed rate locks in your cost of capital, turning the debt into a predictable, manageable expense. Currently, variable rates in Italy are hovering around 2.75% to 3.05%, but saving 0.5% is not worth the catastrophic risk of rate hikes. Lock in a fixed rate. Second, your time horizon must be at least 15 to 20 years. In any 5-year period, The stock market is a coin flip. Over a 20-year period, a broadly diversified index like the FTSE All-World has historically always generated positive returns. You need a timeline long enough to ride out the inevitable crashes. Third, you must have an emergency fund entirely separate from this investment. You should have at least 12 to 24 months of mortgage payments sitting in a boring, risk-free savings account. This ensures that if you lose your job during a recession, you will never be forced to sell your stocks at a loss to pay the bank. Fourth, you need an iron stomach. You have to genuinely know your own psychology. It is very easy to say you are comfortable with risk when the market is hitting all-time highs. It is an entirely different reality to watch tens of thousands of euros vanish from your account while your debt remains exactly the same. Let us bring it all together. Does it make sense to invest mortgage money in a diversified ETF like the FTSE All-Country World? Mathematically, yes. With current TAEG rates sitting below 4% and long-term global equity returns historically averaging over 9%, the arbitrage equation is positive. Over a 20-year period, this strategy is highly likely to increase your net worth. Practically and psychologically, it is a much more difficult question. Leverage amplifies everything. It amplifies your gains, but it dramatically amplifies your losses and your stress levels. It turns a temporary market dip into a test of your financial survival. If you decide to proceed, do it with absolute caution. Shop around to get the lowest possible TAEG. Use a fixed-rate loan. Stick rigidly to a global ETF like the FTSE All-World, resisting the urge to chase riskier tech stocks or crypto to inflate your returns. And most importantly, ensure your daily cash flow is secure enough to ignore the market for a decade. Thank you so much for listening. Financial decisions involving debt and your family home are massive, so take your time, run your own numbers, and consult with a fee-only financial advisor if you need personalized guidance. Let me know your thoughts in the comments below. Would you ever leverage your home to buy stocks? Have a great day, and I will see you in the next one.